We'll go ahead and put this up on our website as well, so you can see that. Our website is drlgroup.net, and you can see this whole presentation. The first slide is the only slide we're going to talk about DRL and really how can we help you. We have 90 years of experience in the business. I've been in the business since 1994, traded through a lot of different markets. Obviously, COVID, of course, and last year was probably one of the worst markets that I've traded in since I've been in the business, with the exception of a couple of spurts, 08, maybe in Detroit, and so on and so forth. Our whole goal for you is to provide you with timely market data. If you're not on our website email lists, I would suggest that you go ahead and get on our list. We send out market data usually every Thursday, and then as the Fed moves overall rates, we'll send that out as well. But our market data on Thursday, it doesn't necessarily just cover muni bonds, but it covers a lot of fixed income type investment stuff, whether it's fixed income for munis, whether it's corporates, whether it's treasuries for that matter. We're going to cover that as well. And obviously economic data is very, very important. We're going to make sure that we're providing you with honest and open and very candid experience and overall thought process in our recommendations to you. We're not going to really recommend the bond of the day, so to speak, what we're long and what we're long in inventory. We're going to really recommend what you as the customer, as the prospect, as the client has really told us what you're looking for, and we're going to cater that around there. I would be remiss if I didn't say that our custody services are National Financial Services. It's a wholly owned subsidiary of National Fidelity Investments, and Fidelity bought National several years ago. For those of you that used to clear through Correspondent Services Corporation back in the late 90s and early 2000s, National Financial is the byproduct of CSC, and that takes you back to that lineage. Fidelity bought them probably about 10 years ago, thereabouts. And we're going to help you guide through these markets. These markets are definitely challenging. And 2022, we're going to talk a little bit about that. That's been a tough year for everybody. And from a challenging standpoint, we're going to do our best to help you as far as what you're looking for and what we're seeing, and give you honest color. And this webinar is a casual webinar. I don't have anything scripted. It's not taped. It's just, I'm just following the slides like you would be, and I'm just going to talk to you like you would be sitting right here in my office. So it's going to be just a casual 30-minute, 35-minute webinar. So the question really is, did we see a bottom? I don't know. It's tough to say. We did see 5% tax-exempt insured paper for a very brief period of time, probably about 2 weeks, maybe 2.5 weeks. And we had a lot of buyers come in and buy paper. It seems like that 5% is the magic number. And I'm not talking about kicker bonds. I'm talking about legit bonds that had a longer dated call date, that had a maturity date of, say, 15, 20 years, that we were able to get 5% on, non-AMT, either AA or AA insured. So quality 5%. We did see that for a brief period of time at the very tail end of 2022. That evaporated very quickly, and it seemed like it was, like I said, about 2.5 weeks. We have interest rate risk right now. I'm not going to sugarcoat it. It's the big elephant in the room with these last CPI numbers that came out, and with the overall jobs numbers that are really strong. I've heard the word sticky probably 15 times in the last 3 days. Inflation sticky. This is sticky. This is going to be sticky. I'm not going to play up on words, but at the end of the day, it seems like inflation is sticky at this moment. Should he have done 50 basis points instead of 25 basis points? It's hard to say. Right after he did that move on 25 basis points, economic numbers came out, and that's when we started to see munis probably go up 5 to 7 basis points across the board. And as I mentioned earlier, the short end of the curve, quite frankly, that's been going up 7 to 15 basis points across the board for the last at least 3 days, probably closer to 5. I'm not going to micromanage this webinar, but I just want to give it context as to things were going really, really well up until about a week ago. And then all of a sudden things started to kind of change. And most likely it was due to the fact that it's the overall thought process. So I'm hearing that you guys can't see the slides, so I want to make sure you can see it. If you can respond back, I just want to be sure that you can see that. So with that said, with that said, what are the current challenges? So let me change the slide deal. Hold on one second. And I'll change this to desktop 1, and you should be able to see that. 2022, let's see, let me change. Ryan, I got you. Can't see the slides. All right, hold on one second. Let me see if I can do this. How about that? Now you can see them, I presume. Can you see them now? So that should work well. So there you go. So great. Thank you, Ryan. I appreciate that very much. So to back up just a little bit, what are the current challenges? That's the slide there. Did we see a bottom or not? Don't really know. But 2022, it created a record outflow. If you bought bonds in 2022, obviously you see what ended up happening to your account. And primarily most of that was due to the fact that we had a record outflow going out from both mutual funds and from individual SMA accounts, which stands for separately managed accounts. So from this record outflow standpoint, people had to get bids on paper. And the end result of that is that as paper came out, bids got lower. It doesn't take a real rocket scientist to figure out that as more paper comes out, whether it's from mutual funds or individual retail customers all the way through 2022, the bids are going to go much lower. Everything below a 4%, that bullet point number 3, everything below 4%, it really caused some problems from the standpoint of getting a bid. It seemed like 3.5%, 3%, 3.25%, all that stuff was just really a throwaway bid for much of 2022. Not to say the overall product was good, bad, or indifferent, but everybody wanted to try to buy 4% or higher. So basically, if you own 3.99% coupon or lower, and you try to get a bid on the bonds, the bid was relatively pretty low compared to the 4%, and quite frankly, a little lower than where they should have been. We had 20 straight weeks of outflows. That was really uncalled for and really unheard of. There was, if you count January 4th, it was amazing to see each day we came in 2022, we had all of these outflows. And quite frankly, that 20-week street outflows, that's more like a 30-week, because we had some weeks in there where they were a little bit indifferent going forward. There were sporadic, as I mentioned before, but overall, the main problem was the outflows. The rise and fall of bond funds. So the reality from a bond fund standpoint is that if you're buying and selling municipal bond funds, they were trying to get a bid in 2022 on paper. They tried to get bids on 2022 paper, say in 2022 for junkier type paper, AAA type paper. They were trying to overall offload, and I've talked about this before, double C rated paper through triple B rated paper. And eventually that bid just dried up. So they ended up having to sell AA rated, AAA rated, and some A rated paper to satisfy the net redemption. So I'm not suggesting that if you own bond funds, they're bad. I'm just saying that make sure you know exactly what you own. Because if you don't know what you own, and if you thought you owned this and they sold that, well, you might end up owning this instead of that. So just be real careful about that. And the fact of the matter is that as they were trying to sell paper, again, the lower rated quality paper had some problems attaining a bid. With that said, to complicate things, we've seen a downward dealer trend in our business. And what that really means to retail is that there's not very many dealers out there that are doing what we do anymore. Yes, you have the Raymond James and the Merrill Lynch's and TD Ameritrade and Ameriprise, all those guys. I get it, Charles Schwab. But from a specific dealer point of view that are buying and selling securities on a daily basis, taking risk on inventory, calculating bid and ask, producing prices from a pricing standpoint to all of the pricing feeds. There's not very many dealers out there that do that anymore. Trading desks are either a prop desk or a prop and retail desk. From our standpoint, we're more of a prop retail desk. The difference between a prop desk and a prop retail is that a prop desk it stands for proprietary account. They're only buying and selling for their own institution, their own firm itself. Whereas a lot of the other desks, such as our desk, we're buying and selling for securities for our own retail clients and people that come in, whether it's a money manager that we work with, whether it's a family office that we work with, or whether it's a mutual fund that we work with. We're buying and selling on behalf of those accounts, and we do take inventory from that standpoint. Coming back from a dealer downward trend, technology has been a really big factor in that. There's not enough dealers that can keep up with the technology. When I got in the business back in '94, the way we did a trade was we picked up the phone, we called Merrill Lynch, we said, what do you have? We had a conversation, a dialogue, we got an offering on something. We then called the client, talked to the client, got the order, called back Merrill Lynch, and either the bonds were there or they had traded. That was an extremely inefficient way to do business. Now, what ends up happening is that everything is on ECNs, which is basically an electronic exchange network. And these ECNs, they're buying and selling securities like Market Access, as an example. They're publicly traded. TradeWeb is another publicly traded company. ICE is another company who owns the New York Stock Exchange. So these ECNs are, think of them as a clearing firm. Think of them as DTC. They're the ones that are intermingling. So everything is fed to all of these dealers through an electronic network. If you don't have the technology to keep that up, then you're not going to survive in the business. DRL makes significant investments in technology every year just to stay ahead of the curve. Who holds munis? This is kind of a myth that's gone back and forth from the time I was in the business. And it's kind of interesting to see. SMA, remember, separately managed accounts, that's Mr. and Mrs. Jones that buys 25 or 50 or 250 XYZ bonds. That's your primary holder. That is our customer, that is our client, and that's quite frankly most of the clients out there. You see their individuals hold roughly 41% of the tax exempt paper out there. That has been shrinking a little bit, but it did taper off. Overall, that used to be around 48% when I got in the business, and that's been almost 28, 29 years ago now. Now it's about 40%. I think a lot of that is attributed to the fact that people are buying in bigger blocks, and or mutual funds are coming in, and you've got family offices that are classified as some sort of an institutional account buying and selling securities, which are classified in that banking institution purple 15.9% there. We continue to deal primarily with SMAs. Our book is made up of roughly 500 to 600 retail accounts. We have 19 institutional accounts and several family offices that we deal with as well. And out of all of that, we continue to recommend high grade paper. We really do not deviate anything below AA, and I'll show you the reason why in a minute. But from a AA rated below, let's say a single A rated, not uninsured piece of paper, we're not saying that's bad, you shouldn't buy it. I'm not saying that at all. But from a bandwidth standpoint, we simply as a firm do not have the bandwidth to monitor credits and monitor interest rates from the standpoint of making a recommendation on a CC or a BB or a BBB rated bond. We just don't simply have the bandwidth. Other firms do, and that's fantastic, but we do not. So with that said, we primarily stick with AA rated high grade paper. What does this mean? That means that I think you, the retail investor, will continue to be the driving force of this municipal market. Institutions such as JP Morgan, Wells Fargo, as they're underwriting securities, they're talking to folks like us, regional broker dealers, that are saying, hey, where should these be priced? What are you seeing out there? What's retail saying? Do they want to stay short, medium, long? Do they want to see AMT, non-AMT, that kind of thing? Do they want to see some sort of structured product or not? So it's evident to me and to our team that retail is definitely the driving force from that. What's interesting, when we go from retail, we go to overseas. And I put this slide in here because what a lot of people don't talk about is that munis are extremely attractive to overseas buyers. And they like that tax exemption, but they particularly like the safety. They like the fact that it's an incremental rate advantage, but they like the safety of what munis bring to the table. So there's been a lot of muni type buyers that have come in and said, hey, look, we want to see this kind of stuff. So you start to see these different types of overall thought processes coming in, where we've seen a rally up until really, quite frankly, last week, but we've seen a rally to where overseas investors have come in and said, hey, look, we'll take those bonds because of the fact that we need them in this particular portfolio to satisfy either this redemption or to satisfy this tax advantage type deal. So as I mentioned on that last point, part of the rally you've seen is due to this overseas buying. We do believe, along with others, think that that's going to definitely increase in 2023 and 2024 as well. This kind of goes back to the mutual fund outflows and inflows. So that graph there on the right-hand side, that is all of 2022. And as you could see, it was pretty bloody from the standpoint of outflows. Obviously, the lines going down are outflows and the lines going up are, of course, inflows. You can see where it kind of changed at the end of December. It's funny, I would challenge anybody, if you have the time, to go to cnbc.com, go to a search where you search for a ticker, go to the ticker MUB, like Mother, Uncle, Bravo, and look at that as a graph, and maybe look at that for the last, say, 24, maybe 24 months should do it, and look at it starting January 1st, really January 2nd, really, because for the 1st was a holiday. But look at it January 2nd, and then look what happened all of 2022. It's really interesting to see how that MUB changed significantly on January 2nd. I'm not going to debate whether or not we had a bad year. Obviously, we already know we had a bad year in 2022. But MUB, it's like somebody turned on a switch and said, we're selling all munis. And it's just not MUB. It's just everything in general. The outflows for all of 2022 just continued to just accumulate. And there was obviously a couple of inflows, but not enough to talk about. This year, even this week, believe it or not, we've had inflows for all muni bond funds from the standpoint of a net inflow. This year started off really good. We started to see a turn at the end of October. November was a great year. December was relatively flat. I'm sorry, October was a flat. November was a great month. December was relatively flat. And then January was also a pretty good month. This month is still yet to be determined, but we started to see those inflows start happening at the end of October, and then into the end of December, and then obviously into January. And we're still seeing them today, believe it or not, which is quite interesting. But the bottom line is that I would recommend anyone to try to track that on the weekly or monthly from the desk of that we send out, whether it be on LinkedIn or whether it be on our webpage or whether it be through a direct email. We normally track that for you and kind of give you an idea of what the flows are, which is kind of good from a standpoint of calculating what yields are going to do and where yields should go and so on and so forth. Market sales, obviously, with rates going up, it's logical to think that market sales are going down. What do I mean by market sales? I mean the overall new issuance of paper. So I live in Houston as an example. Houston comes to market with say a water and sewer bond, and they look at the market and go, wow, I should have issued bonds back in January of 2022, but I didn't because yields were 2.5%, and now they're 4.25% on the long end. I think I'll hold off. That's what we're seeing right now. We're seeing the municipal type paper from, in this example, Houston, being held back because of the fact that they simply just don't want to issue paper in this environment. Pretty easy to understand. So therefore, what's happening is that the supply out there, remember, munis are based upon supply and demand. The supply out there obviously is lower, which of course you would think would help pricing. Obviously, this week it hasn't, but overall, you would think it would. We don't really see that, along with others. We don't really see that getting any better. Obviously, with the Fed saying they're going to increase rates another 2, maybe 3, maybe even 4 times. We can debate whether they're going to do 25 or 50, and that's not really the point. The point is that most municipalities believe that it's going to be a better issuance environment at the end of this year and going into 2024, as opposed to, say, March, April, May of 2023, as an example. So we're not really seeing a lot of issuance. That might change. March is typically a heavier month, and I would think that from a March standpoint, we're going to see a little bit more issuance than what we've seen before, but I don't think overall it's going to make that much difference. I put that little comment in there, entering a new year with baggage from 2022. Believe it or not, the JP Morgans of the world, the large issuers and the underwriters are still licking their wounds from 2022. They're still trying to figure out what ended up happening and how did that whole interest rate thing go about. Obviously, we can debate inflation and the Fed was behind the curve and all of that stuff, and that's not the point. The point is that we are definitely entering 2023 with baggage from 2022, and underwriters are extremely cautious as far as what's going on. And municipalities are much more comfortable tapping not only from later in the year of 2023, the market that is, but they have plenty of cash on hand. If you remember back during COVID, there were 2, maybe 3 packages that were done by our federal government. And again, we can say that this all came back from 2020, 21, and 22, and this is why we're seeing all of this inflation, which I would tend to agree with. But the reality is that a lot of that money went to these municipalities, and a lot of that money went to these municipalities for shoring up their debt. So they have plenty of money. There's no real reason for them to come out at these high rates and go, hey, I want to go ahead and issue paper, unless they absolutely have to. So be cautious about that too, and make sure that they're well insured. What's it going to take for the yields to stay low, go low, move low, whatever you want to put there? The reality there is that the preferred inflation gauges by the Fed, the CPI, the PPI, obviously the unemployment numbers, these are really what's driving the data for the Fed. Everything that the Fed talks about are pretty much those 3 things: CPI, PPI, jobs. They're talking a little bit about mortgages, obviously, but what's it going to take? It's pretty simple. It's going to take those numbers to come down. Why did we see a spike in yields over the last 5 to 10 days? Is because it's obvious. PPI, CPI, and jobs are holding in there very well. And those other 2 numbers were higher than expected, actually quite higher than expected. Jobs were quite higher than expected, the numbers. So the Fed is looking at this going, uh-oh, wait a minute. We believe that this is going to continue. Remember the whole they were talking about inflation and it's transitory and all this other kinds of stuff. So they're not using that word anymore, obviously, because they're looking back and going, well, we should have maybe jumped on the bandwagon a little bit more sooner. But with that said, we believe that these numbers eventually will start to head back down. There are data points out there that point to CPI and PPI coming back down next month. I'm not going to speculate on that. This is not a forecasted call. This is just talking about munis. In my opinion, I think yields will be lower in 6 months than what we're seeing now. And with the curve so high, the yields on the curve so high from 1 to 5 years right now, I mean, you have to be thinking as an investor, why are yields so high in say 8 months from now? Why are we buying a 3.2% tax exempt bond for 8 months, as opposed to why am I going out another 15 years or 12 years to get a 425? Basically pick up 100 bips is really what it boils down to. You really have to think about that. Are we headed for a recession? Do the people buying the short-term paper don't want to hold the short-term paper anymore because they don't want to be stuck with bonds coming due in 12 months or 6 months or 9 months or we'll say a year and a half, and rates are going to be lower? Everybody's situation is different. You might need to buy a 12-month piece of paper for liquidity reasons, and other people might not care about that. So they want to get the most yield. So everybody is different from that standpoint, but it is an interesting fact from there. And then from there, we do see that hikes continue to slow. I would think I kind of maybe think they should have done 50 basis points. Obviously, hindsight's 2020, but you know, they did 25. Are they going to do another 25? I don't know. If they continue to have these hot numbers, they might go ahead and step it up to 50. I don't think they do 75. And I personally, I don't think they pause either, obviously. But at the end of the day, I think they do 25 or 50 on the next route. And I think if they do 50, that might spook the market a little bit, but I think the market would digest that. Quite frankly, if they did 50 on this last meeting, I don't think we would be seeing what we're seeing today. I think you would have a much calmer market, personally. CPI numbers, that's CPI numbers, that blue line there. Obviously, it's coming down. It obviously went up, of course, this last number, but it is coming down, and it's coming down across all factors as well. The short-term yields, that kind of gives you an idea from a muni index standpoint. Right now, as I mentioned, say August paper, let's say 2023 papers yielding around a 320, 315, 305, 310, and that's all AA insured stuff. A longer dated paper is a 420, 425, 415, right in there somewhere, 428, maybe a 430 on some other stuff. If you're buying Chicago paper, you can probably get a 430, 435. But with all of this said, the reality is that if you want to stay short, you're, for the lack of this call, say at 320. If you want to go long, just say you're at a 420. So you pick up 100 bips. If that's worth it to you, then great. If not, no big deal. That's the way it is. The duration of the muni index definitely did decline. In other words, we saw issuance in 2022. The longer dated stuff was not being issued as much as the shorter dated stuff. So it's interesting to see what's out there now, where a lot of this stuff's 32 maturities, 37 maturities, that kind of thing, that were issued in 2022, as opposed to what you would think, say a 30-year maturity versus a 35 or a 28-year maturity. So it is pretty issue. It's pretty interesting. The result is the yields have come down. The fact of the matter is yields have come down. They've come down since October of 2022. I'm not talking about the last week. And prices are up. Will it continue? It's going to be hard to tell. I personally, as I mentioned before, think it will continue. I think we're in for a little bit of a bumpy ride for the next 2 weeks to 3 weeks. March, as I mentioned earlier, is going to be a little bit heavier in issuance, so we probably can buy some good stuff sometime in the month of March. But after we get through March, it's going to go, the calendar is going to be light again. So we're going to see what happens. What is the outlook? So what's the outlook from a muni standpoint? Sales are going to be roughly 20% lower, and that we've already covered that. We don't need to belabor the point. Municipalities are not going to be issuing paper, not in specifics, but they're, instead of an average daily, let's say average volume is 12 billion, 12.5 billion, probably looking at 6.5 billion, roughly thereabouts, something like that. So that is going from the standpoint of going down, which we think will continue to, by the way, be around 6.5 to maybe 9 billion. So I think it'll be a lower supply. It is really interesting to see a positive return. I don't really think can be fully realized until the outflow cycle begins to really subside. And what that means is, and that's kind of a fancy word, a fancy way of saying, we need to stop seeing these outflows in these municipal bond funds. That's what we need to stop seeing. If we continue to have these outflows, then it's going to put pressure on the market. It's pretty simple to understand. If there's a bunch of stuff out for the bid, it's simple. You're going to have a problem, and we need to see that. We report that. I would recommend that, again, look at our emails, and we're very cognizant about that. How do we combat that? We really look at bids, and if we see bid one has come out, we see heavy calendars, we see heavy outflows. Obviously, as dealers, we're going to adjust our bid just like everybody else. So that means prices go lower. We've really got to see that slow down or reverse. So far, knock on wood, we've seen that. So we'll see what happens over the next couple of weeks. We don't have a credit problem. I've mentioned this before to a lot of our clients. We don't have a credit issue. Credit meaning the security of the municipality. DRL does not trade anything that would be questionable. We have a pricing problem. We have an interest rate problem, but we don't have a credit problem. I've told a lot of clients of ours, I'd much rather have a conversation with you about, hey, we bought this bond, the price went down because the yield went up, but the price didn't go down because the municipality is in bankruptcy. We don't play that game. If it's in bankruptcy, then now all of a sudden you're getting back 40 or 50 or 60 cents on the dollar. We were involved in Puerto Rico. We're very familiar with Puerto Rico. If you own Puerto Rico, particularly the AGM insured stuff, particularly the highways, where right now the electrics are going through restructuring. We're extremely familiar with that transaction. So if you want to talk about it, give us a call tomorrow and we can definitely talk about it. Overall, we think yields are going to grind lower, and it's just not us. There's a lot of people that think the same thing. What to watch for? So this is kind of covering what are we going to be looking for in 2023. It's going to be interesting to see what happens with tax exempts and how the yields are going to go. Again, we kind of believe that yields are going to go down between now and the end of the year. Obviously, prices moving up. I think that supply is going to continue to be low, which is going to be good. And I think that credit quality is going to be high. So I don't think that there's going to be any issue there. Issues to watch for, making sure that you're buying and selling good quality securities for market composition. Don't buy stuff if you don't have to. Make sure you're trying to buy the product as close to the bid as you possibly can. We operate a trading desk and we bring the product in. You're avoiding that middleman. Just make sure that you're buying the product as cheap as you can based upon the bid side. And we help you with that for sure. I would expect more defaults personally on the lower credit quality side. We're already starting to see it. Malls, for example, nursing homes, hospitals, some multifamilies that are poorly maintained. We're starting to see that. Munis have navigated a recession. I've got a slide coming up. It's going to be showing you the recession. You, the buyer, can take comfort in making sure that if you own quality securities, the performance of muni bonds during or post-recession has been largely positive. 1981 and 2008, those were the only two times. Everything else has been really strong. So we really feel good about owning high quality debt. If you own lower quality debt, we're not speaking to that. The challenges are going to be a recession, and will people need to sell, whether they're on margin, whether they're not on margin, and whether the margin is being managed properly. That's also very important. Just be aware of the fact that if we do run into a recession, or if we start to see on CNBC, oh, there's a recession, there's a bad, this is that. I saw Don Peoples talking today about, overall revenues declining in the apartment sector and then obviously in the office sector. So what's happening? Are we going to hit a recession or not? Munis definitely perform very, very well in that type of an environment. Quite frankly, they should follow the traditional playbook. The fixed income market right now is suffering from indigestion. Remember that baggage thing that we spoke about a couple of slides ago? It's the same thing. It's taming the inflation. It's suffering from indigestion. We've got to get over this outflow of mutual funds. We've got to get over this. Are these things going to 5%? Or we've got to get over when are they going to stop raising rates? We don't know any of that stuff. And I'm just being bluntly honest with you guys. We just don't know. But we think we're closer to the end than we were in February of 2022, which when all of this pretty much started. So whether they raise another 3 times, 4 times, 25 bips, 50 bips, whatever it is, we don't think it's going to be 75, 75, 75, 75, 50, 50, 20, 25. So we think that's pretty much over. Now, what does that mean? Well, you kind of start to see the end of the road there. You kind of get excited. And that's what we saw. That buyer mentality came in over the last 3, 4, 5 weeks, 2 months, that kind of thing. The expectation is that, I know that's kind of weird, the curve flattening, but if you really think about what I just said, if you're buying a 320 on the 9-month paper, and you're buying a 420 on the, say, 15-year paper, and we say, okay, that 320 is going to continue to move up to a 4, well, maybe not a 4, but a 328 to a 350 to a 375. And then all of a sudden that's kind of a flattening. I think that 420, 425 kind of holds on the far end. So in other words, if you're looking for higher yields on the shorter end of the curve, that's probably going to give you a pretty good opportunity to buy those higher yields. Remember, when they come due, just remember, if you make that trade, the yields might be lower, obviously. Of course, they could be higher, but the market is telling you, at least, forget about what I'm saying. The market is telling you the yields are going to be lower when those bonds come due. That's what the market is telling you. Whether the market's right or not, we're not here to debate that. So that's from a flash thing. How can you profit, right? Everybody wants to make money. Everybody wants to figure out how they can profit from this stuff. Fixed income inflows, as we already discussed, are outpacing. So that's good. They're outpacing equity. So that's really good. That's actually from July. Income fund flows have picked up, as we already discussed. Quality will be the key in 2023. Just be careful about, if you're not a client of ours, just be careful about what you're buying. Run it. If you're not a client of ours and you have a question, call us. If you're a client of ours, you shouldn't have an issue, call us. With yields unlikely to go above their peak level. That means a fancy word of saying, are they going to hit 5% again? I don't know. I don't think so. I'd be shocked if we hit a 475. We could. I'm not a fortune teller. I'm not going to sit here say that they're going to do this, that, or the other. But, if we hit a 5%, all I can tell everybody on the call is to make sure you take advantage of it, because it lasted for a nanosecond and it went away. I mentioned inflation. So all of those things there. So those little red vertical lines there, those little red, that's inflation. So look at Muni. So Muni performance afterwards. So Muni performance did pretty good. Again, this is recorded. We'll put it up on our website. But all of those little arrows there, those little, I guess, turquoise, I guess is what that is. It's pointing to the Muni performance after inflation. So obviously on the far right, you can kind of see where the outflows happened and whatnot. But, most Muni buyers, as this stuff gets cheap, guess what they do? They come in and buy. So they're like, oh, okay, cool. We're going to go ahead and buy. Market structure is weighing on 2022. What does that really mean? To sum that slide up, at the end of the day, it's really bullet point number 2. It's that we were fueled by this constant pushing money out to everyone and their brother, and that included municipalities. That's good for credit quality, but it's really bad for inflation. Quite frankly, it really caused what we're seeing now from a monetary policy standpoint. Powell and everybody else is looking at this going, okay, how do we fix this? Everybody's talking about what do they say, like a soft landing or no landing or a hard landing. It's really based upon that. Tax collection rates, data point number 4, or the last data point there on bullet point number 4, actually have been pretty strong. If you read Illinois' paper, Illinois' documents that have come out, tax collections for Illinois, California, New York, and New Jersey, which I didn't put on there. Those are the 3-4 hot states that we watch. We live in Texas, obviously. Texas is obviously extremely strong, but those 3 or 4 states have been very, very good. We actually have been buyers of Illinois, California, and New York paper, only on the AA rated paper, and they've done pretty good. Pension funds, this is an interesting topic, and this is really not spoken about, and I'm glad that you are made it to this slide because this is really important. Pension funds have a ton of cash, and they're looking at this because of the fact that they liquidated a lot of equity, a lot of private equity. They had some liquidity events. They are in the process of purchasing munis. They are buying that credit asset class, focusing on A-rated and better. They have the opportunity to unwind their balance sheet and buy high-grade paper. I'm not suggesting they're buying all high-grade paper, but they have the opportunity to buy high-grade paper. It's important for you to know that because already we have a lack of supply. We have obviously yields are relatively high compared to 12 months ago, and we have a lot of cash on the sidelines. So as pension funds come in with cash, they're looking at this going, what do we do with it? Where's the opportunity? Munis obviously has been one of those opportunities. That is pension funds surplus and excess. Surplus and deficit. So deficit has been the orange lines there. Obviously, surplus are the white lines there. So right now they're sitting with a surplus, and it's a large cash balance. They're going to be buying, which they've already started, and we see it, high-grade tax-exempt paper. So the next question is, where are they buying that paper? Are they buying it short end, long end, medium end, whatever? They're primarily sticking in the longer mid-range, I'd say 10, 12-year paper, all the way out to, say, 15 to 17-year paper. In some cases, they're buying some 6-month to maybe 24-month paper, but that's on some rare occasions only from a cash management standpoint. So that's just interesting. Outpace equity inflows. So bond inflows versus equity inflows, a couple of slides ago, they're starting to really outpace that. Again, 3 or 4 slides ago, what do we need? We need the mutual funds to stop selling paper, period. That's what we need. If we do that, then we're okay. There you go. Bonds sales. That is bond sales, meaning new issues being issued by the underwriting community. That's all of 2022 pretty much. And then obviously in 2023. At the first of the year, we had heavy bond sales. and then they've just died off. And that's not really normal, to be honest with you. I mean, it doesn't just die off. It's basically died off, and it's died off because of everything we spoke about today. That's going to help you as your existing bonds that are in your accounts should help the overall valuation of those bonds. DRL put out, and it was funny, pound the table is our internal type word that we use. We put out a letter where I put that overall arrow there saying, hey, look, we feel that yields are good. We feel that they are worth buying, etc. If you were on our mailing list, you got it. You know exactly what I'm talking about. It came out sometime in the middle of November. I think it was around November 11th-ish or so. And we felt that's kind of where we were seeing that 490 to 505 range. We were like, man, this has got to be a good time to buy. So we did alert our clients about that as far as the pound the table letter and whatnot. If you did buy bonds in 2022, which I'll be the first to admit, we bought bonds in 2022, you weren't alone. April 2nd, I'm not going to go through all of those, but look at all of those firms and the dates. They said, hey, this is a good time. These are good. This is closer to the end. You know, Vanguard indicated attractive from uni buyers back on May the 11th. Don't feel like you got, duped, or don't feel like the market was against you. There was a lot of buyers in 2022, all through 2022, quite frankly. If you felt that yields were going lower and you sold everything in January, then God bless you. You did a great, yields went higher and you sold everything in January, God bless you. Then you did a great job. But unfortunately, most people didn't do that. We saw a pretty bloody 2022, and luckily we started to recover, like I said, in October. What is priced in the market? So we're about done. I got 2 more slides, so that's all I've got, and then we'll get out of here. What's priced in the markets right now? We've got the Fed. I don't know. I kind of wrote this about a week and a half ago, 2 by 25 bips. I kind of maybe think that's going to be 3, and it might be another 50. So I think that first bullet point, quite frankly, is outdated. And I just, again, wrote this a week ago. So, but with all of that said, at least 225 basis points. We can pretty well all assume that. And I would say even 3. And we probably, as I said, we'll have 150 in there somewhere, maybe next one. The Fed has acknowledged inflation. They've vowed to say, hey, we got to get it down to 2%, 2%. That's not going to happen. That's unrealistic. It's just not. And guess what? Everybody knows that, not because we're sitting here on this call on a Thursday evening. It's just everybody knows that. And a 2% is unrealistic. That'll take for a long time. That'll take forever. That's pretty well priced into the market. The correlation between munis, it's starting to come into reality. In 2022, we were looking at munis going, wow, you know what? The equity market's going down. Munis are going down. All asset classes are getting hammered. We thought munis were supposed to be some sort of hedge against the equity market. Well, didn't work out that way. Unfortunately, munis were not a hedge to the equity market, and they pretty well traded in tandem. So as they traded in tandem, everybody was like, whoa, wait a minute. I buy, the old 60-40 rule or 80-20 rule or whatever rule you want to go off of. I have this for my own individual personal portfolio. I thought my muni account would be doing well. Well, unfortunately, it didn't. And your equities didn't do too well. I think, I don't know if you bought or sold equities, probably didn't do well. And so, but now what's happening is that's kind of coming back into correlation. So we are starting to see an inverse move between equities and munis now. It's kind of acting a little bit more, let's say, normal. And so as we're looking at these munis and seeing these equity markets, like today as a good example, we're seeing these equity markets trade down, we're starting to see a better bid come in for munis. Today, yields were marked up maybe 4 or 5 bips on the long end. Again, we had a 7 or 8 bip markup on the short end, but we're starting to see that correlation. Weaker earnings are really hurting the QQQs of the world because of the fact that all of this IT stuff going on, Amazon, Google, you just open the paper, people are laying people off. I'm really questioning these jobs numbers, and that's a debate for a whole nother day. But you wonder why these jobs numbers are so good when I open the paper and see Amazon laying off a bunch of friends, a bunch of people, and whatnot. Where are bonds trading? That's a little outdated. Bond long end is trading roughly at a 420, like I mentioned, 425. Mid-range 3, that's about right. Short-term paper 1 1/4, that's not right anymore. I would say anywhere between 2 to 320. So that 125 has now become a 2, and that 310 has now become a 320. If you have liquidity issues and you need to be liquid in a 12-month period of time, it's probably a pretty good time to buy short-term munis, quite frankly. I'm not suggesting they go straight up in price from here, which it really doesn't matter because they're maturing anyways. But if you have a taxable, our taxable money markets are yielding roughly about a 430. I'm sure your taxable money markets are yielding about the same. If you've got a tax issue and you come in and go, okay, look, I'm looking for a good quality muni that's going to give me at least an equivalent of tax exempt, but I want a taxable, but I want the insured piece. Well, that's probably a pretty good time to look at this stuff right now. We're buying all across the curve. We're definitely not going out further than 25-year paper. We are focusing on call dates, so we want to make sure that the call dates coincide with kind of the ladder. We believe that all of this is going to pass in a couple of years, and call dates are now going to become a thing of something to be importance of, and we're going to look at it. We're slowly buying at these fresh levels. Obviously, we bought heavy in October. We bought heavy in September. We bought heavy in November. We kind of tapered in December and tapered in January, and then resumed paper middle of January through now, really. And so everything that we've been buying, we're probably buying 10 to 15 basis points higher than where we were buying, say, 3 or 4 or 5 weeks ago. So everything is definitely ratcheted up. We're slowly, from the standpoint of looking at high yield to call paper, we call those kickers. We are a big kicker buyer, meaning that 5% coupon callable in say 2020, latter part of 2023, first part of 2024. We're buying those as close to par as we possibly can. We get a high current, and then it's a low yield to call. So that's kind of what we think from the standpoint of that. We think volumes are going to pick up slightly in March from an issuance, like I've mentioned before. February is a high coupon month. Quite frankly, January was too. If you own Puerto Rico and if you own the insured paper, you got paid a whole bunch of money as well, plus some redemptions on the principal paper as well. The sell-offs we think are pretty rare in this muni history. I mentioned at the first of this thing, I started in 1994. 08 was pretty tough. 2009 was pretty tough. Obviously 9/11 market closed. I saw a big sell-off there. It was really hard. COVID, of course, we saw a sell-off there as well. But 2022, that was a really unique time in history, one of the worst ever, quite frankly. And so I think it was not a fluke, not a one-off, because in our lifetime we're going to see it again, and everybody's lifetime we're going to see it again. We don't know when it's going to be, but it rarely happens twice in a row, like 2022, 2023, and so on and so forth. So based upon that, I think that we're kind of seeing these fresh levels. We do think volatility will be slowing, and we do think that overall value will be a big credit issue going forward. I do think if we do head into a recession, we're going to see some sort of a major default. So I'm not saying it's a Meredith Whitney default by any stretch of the imagination. But what I am saying is be careful of what you're buying, because if we do head into recession, your lower rated securities will be hurt, and you might have some issues. I would ask you, if you're not on our website email list, go ahead and send us an email. We'll put you on the list for sure. We'd like to know your comments about the webinar. Give us a call tomorrow. We'd love to talk to you. If you're not a client, we would love to talk to you about what we do and how we do it. And obviously our clients, we love talking to you guys too. We talk to you guys all the time, and it's a joy and a pleasure. I feel very blessed to do what I do and talk to great people like you guys. And I appreciate the overall attention and hanging with me. I don't think we lost anybody on the call, so I was really privileged to see that. So give us a call. We're here to help you. Even if we give you advice and give you advice on stuff that you own, we're happy to help you on that as well. I appreciate your time. I hope you have a really great rest of your evening and a terrific Friday. Thank you very much, and have a great day.